All right, let's just cut to the chase. If you've been staring at your paycheck, trying to make sense of the fine print, or worrying about tax season, you are exactly where you need to be. Welcome to today's explainer. We're going to completely demystify the complex math behind India's tax regimes so you can confidently optimize your take-home pay. Look at this number, $50,000. That's not just a random figure we pulled out of thin air. That's the amount of money you could literally be handing over to the taxman this year, totally needlessly. Because here's the thing, if you aren't paying close attention, the government's automated default choice could silently drain up to 50 grand from your pocket without you even realizing it.
So, the big question, are you losing money? This is the high-stakes reality for pretty much everyone right now. Salaried professionals, freelancers, NRIs. You really need to ask yourself if you're accidentally leaving your hard-earned money on the table. If you just blindly accept the status quo, well, the answer might just be yes.
But don't panic. We've got a roadmap to figure this all out. We're going to cover the costly default trap, compare the new and old tax regimes, break down the golden break-even rule, look at some real-world taxpayer scenarios, highlight common mistakes to avoid, and finally go over deadlines and the final verdict. Starting right off with Section 1, the costly default trap. The whole foundation of this tax confusion really boils down to one word: automatically. Since assessment year 2024-25, the government made the new tax regime the default setting. It just happens silently in the background of your company's HR software. Meaning, if you do absolutely nothing, you might get locked into a system that isn't mathematically optimized for you at all. You literally have to actively opt out if the default isn't the right fit. Moving into Section 2, new versus old tax regimes. So here's the core debate in a nutshell. The new regime is built to be the default, and it's built to be simple. It intentionally strips away most of those classic deductions we all grew up hearing about, giving you a cleaner filing process and return. But the old regime? Sure, it's complex, but it's incredibly flexible. It has a lower basic exemption limit, yeah, but it lets you build these custom tax shields using your investments, your rent, and your insurance. Let's look at the actual math for the new regime. Income up to 3 lakh is nil. Then it gently climbs up to 30% for income above 15 lakh. But here's the real magic trick of the new regime. You also get a $75,000 standard deduction, and thanks to the Section 87A rebate, if your income is up to 7 lakh rupees, it's effectively completely tax-free. I mean, on the surface, it looks incredibly appealing, right? But here is the crucial catch. While those new tax rates are undoubtedly lower, the brutal reality is you lose almost everything else. You completely lose your HRA, your house rent allowance exemption. You lose your ADC deductions, which means zero tax breaks for your PPF, your ELSS mutual funds, or your life insurance. And say goodbye to your ADD health insurance deductions. If you rely heavily on these to lower your tax burden, the new regime suddenly doesn't look quite so friendly. Conversely, let's look at the old regime. Here, you get to keep your entire arsenal of tax shields. You keep your ADC limit up to 1.5 lakh rupees. You keep your ADD health insurance premiums, you get to claim HRA if you pay rent, and critically, you can claim up to 2 lakh rupees on your home loan interest under Section 24B, plus a standard deduction of $50,000. Basically, the old regime rewards you for investing, insuring yourself, and paying off a home loan. Which brings us to Section 3, the golden break-even rule. Look, trying to calculate the exact difference between these two regimes for every possible salary is just going to give you a headache. So instead of forcing you to do complex calculus, we use a really simple golden rule of thumb. Here's the first half of it. If you add up all your combined deductions, so your ADC investments, ADD insurance premiums, HRA, home loan interest, the whole shebang, and that total exceeds approximately 3.75 lakh rupees, the old regime is almost certainly going to save you more money. If you cross that threshold, you are a prime candidate for sticking with the old system. However, on the flip side of that rule, if your total eligible deductions are below 2 lakh rupees, the new regime almost always wins. This is super true if you don't have a home loan, you aren't paying high rent, and you just have minimal ADC investments. In this lower deduction territory, the lower base rates of the new regime mathematically overpower the few deductions you might be claiming in the old one. All right, Section 4, real-world taxpayer scenarios. Numbers in a vacuum are kind of tough to grasp, so let's see how this actually plays out in real life with some everyday taxpayers. First up, meet our young salaried professional. They earn a 10 lakh gross salary and rent an apartment. Under the new regime, factoring in that $75,000 standard deduction, their tax outgo is around 57,500 rupees. Under the old regime, by maximizing ADC, claiming some HRA, and paying ADD, their tax drops to 50,000 rupees. So they save about 7,500 rupees. Now they have a choice to make, right? Is saving 7,500 bucks worth the hassle of submitting rent receipts and gathering investment proofs? For some, absolutely. For others, the sheer simplicity of the new regime is worth that 7,500 premium. But wow, look at the drastic contrast here for a mid-career professional earning 15 lakh rupees who happens to have a home loan. This is exactly where the old regime flexes its muscle. By utilizing the full ADC limits, claiming that massive 2 lakh rupee home loan interest deduction, and keeping their health insurance deductions, they can save a massive 40,000 to 80,000 rupees in taxes compared to the new regime. If you fit into this demographic, letting your HR software default you to the new regime is quite literally throwing a vacation's worth of money out the window.
Finally, let's consider a freelancer or consultant making 12 lakh a year. They don't have a traditional corporate HRA setup, and let's just assume they don't have a home loan yet. For them, they just don't have the heavy-hitting deductions required to make the old regime work. So the new regime is the undisputed champion here. The math is clean, the filing is way simpler, and their tax outgo is minimized. Okay, moving on to Section 5, Common Mistakes to Avoid.
Even when you're armed with all this math and our golden rule, folks are still falling into a few very common and very expensive traps year after year. Let's clear these up right now. First, never assume default means best for you. Second, if you don't declare your choice to your employer at the start of the year, your monthly tedious deductions will be completely mismatched to your final liability. Third, and this is a biggie, claiming HRA while filing under the new regime will guarantee your return gets flagged. It's just not allowed, period. Fourth, if you have business income, you've got to be careful because there are strict restrictions on switching back and forth between regimes every year. And lastly, non-resident Indians face entirely different exemption rules, so NRIs cannot just assume they get the full suite of old regime benefits.
Finally, Section 6, Deadlines and Final Verdict.
We've covered the mechanics, the golden rule, the real-world scenarios, and the traps. So what is your immediate next step? Well, this is the single most crucial piece of information for you today. Even if your salary slip currently shows that your employer has been deducting tax according to the new regime all year, you are not trapped. You can absolutely still run the math, switch regimes while actually filing your tax return, and claim your excess money back as a refund. But, and it's a massive but, you can only do this if you hit that July 31st tax filing deadline. If you file a belated return, you completely lose the power to choose. Your money, your lifestyle, and your choice are completely on the line before July 31st. Seriously, sit down, run your numbers against our 3.75 lakh break-even rule, and make an informed decision. But all of this leaves us with a much bigger question for the future. As the government makes this simple new regime increasingly attractive year after year, are we witnessing the slow, intentional extinction of the old regime altogether? Think about it. Thanks for joining me on this explainer, and I'll catch you next time.